All right, we're back with Dimitri. Excited to have Dimitri back. Had a bunch of awesome conversations with Dimitri over time, focusing on geopolitics and the commodity cycle, equity cycle. He covers a lot of different things, just like I do. He's kind of the other half of my macro trend following brain. Dimitri is the one that puts context into it and also puts a lot of color on the geopolitical picture. So I'm always excited to have Dimitri on. We also got to meet last week in person. I was out in California for an event. Dimitri, I was fortunate that Dimitri could make it up that day, and we got to hang out a little bit, get some lunch together, and just chill. That was a lot of fun. Hanging out with you and all the All Star Charts guys. Just had a really good time. So I just want to thank you for coming out. That was a lot of fun.
Yeah, definitely. I mean, any excuse to drive up north to wine country. I mean, you guys picked a beautiful day too. I mean, it was just stunning weather. And yeah, it was nice to meet everybody. And I know I was definitely in the right place because within 5 minutes of meeting your friends and colleagues, we were talking palladium already. There wasn't,
Yeah.
oh, where are you from? Where'd you grow up? Where'd you go to school? It's here's the outlook on palladium or here's the outlook on oil. So I knew I was in good company.
No, that was a lot of fun. And even for me, I don't drink, and being out in that area, it was still beautiful. It was really a beautiful place. I never really thought I'd ever go to, Sonoma or Napa, any of those places because of what, I don't drink anymore. But going out there, it was really beautiful. We actually went to a garden at the end of it. It was like a local garden as a community garden in Sonoma, and it was one of the coolest gardens I've ever seen, with the biggest blackberry bush I've ever seen, and some of the coolest insects and beehives and all types of stuff. It was really really cool. And there's a chicken farm there. I mean, it was a cool place. I really had a lot of fun there.
Yeah, great place to go up in the summer, especially to escape the SF fog in June and July and mostly August. So we only in SF get our sun in September and October.
Oh, really? Huh.
Yeah. There's a whole delay. There's that platitude of a quote from Mark Twain, which is the coldest winter I ever spent was a summer in San Francisco. So it's always amusing to see tourists come here in shorts and a tank top or a t-shirt, and they're just absolutely freezing because there's just a wall of fog separating them between the golden hills of Santa Rosa, where all the wine country is, and Sonoma, and then in the city.
I'd assume Sonoma's then that's also, commodity related, which is that's why they grow grapes out there,
Yeah.
more sun, less humidity, probably perfect weather. We have a place in Ohio. It's not in Ohio that's like that. It's an island in the Great Lakes that's kind of similar, where there's a lot of growing of grapes and grapevines because of the weather being very good for that. So it's kind of interesting. It was a beautiful area. Can't talk about it enough. I'm fortunate that it was there. I was happy to get some sun. Ohio's the least sunny state in the Midwest. It's pretty miserable sometimes. I grew up in Cleveland, so I'm in Columbus now. So it's almost beautiful here. People are always like, "Wow, it kind of sucks in Columbus," and I'm like, actually, if you lived in Cleveland, there is no sun. There's 4 or 5 months of winter. The lake effect snow is crazy. So I mean, it's a little bit better where I'm at now, but living on the West Coast, man, you really just can't beat it. Humidity's vastly different too. So
Yeah.
it's another thing to always keep in mind, the humidity. So excited, and like you said, we're talking palladium, talking about lead. Lead's used in a lot of different products. It was catching a bit of a bid lately. So it was cool to just have those conversations, you to jump right in there. It's a lot of fun, man. So thanks for coming out. Speaking of commodities, let's jump right into oil. You had some great ideas of what to talk through today. One of them being OPEC. What's going on with OPEC right now? What's the outlook? I saw you had a tweet earlier. So what are you thinking here about OPEC?
Yeah, so it looks like the reason why markets haven't really responded to it, well, one, the event hasn't happened, and two, markets are forward looking. But essentially, the idea is that we're going to just see a rollover of the existing cuts already. And in my view, the Saudis that are really leading this involuntary cuts, there's a lot of geopolitical intersections here which make it interesting. So, from a domestic perspective, Crown Prince Mohammed bin Salman, or just MBS for short, not to be confused with mortgage-backed securities. But essentially, his idea is he wants to push through what everyone commonly knows as Vision 2030, and what that does, or essentially the main idea behind that, is transforming Saudi Arabia's economy away from one that's dependent on oil and towards other sources of revenue for their GDP, right? So whether it's tourism, sports, gaming, etc. And that falls in line with their other parallel initiative to transition away from oil to become a central hub for hydrogen, both blue and green, with green being the fact that they can use electricity derived from solar power to catalyze electrolysis, which then gets you hydrogen. And then there was like blue hydrogen, which is separate, and they have their whole gas infrastructure that's set up for it. I wrote about this actually for a think tank that I was commissioned to write for, talking about how Saudi Arabia is trying to transition itself from the oil paradigm to the new paradigm without being left behind, but being a central player in it. But we can get into that later. All that pretext is to say that is partially what's driving their motivation to keep oil prices elevated, because these initiatives are extremely expensive and their main source of revenue is still oil. So they want to keep a really good margin for their price per barrel. So that's the domestic factor. From an international perspective, right? Obviously, their decision to cut production and keep it sustained has rubbed the Biden administration the wrong way. Obviously, inflation is the story of the year and has been for the past several years. And elevated oil prices, not only does it hurt, potentially domestic votes for Biden, but it could also fund Russia's war machine vis-a-vis Ukraine. So there are those geopolitical machinations there, which also complicate it. In terms of the growth outlook, though, I think they're cutting on the assumption that growth is going to continue to be strong into the latter half of the year. We're about to be at the crux point between H1 and H2, and we're about to transition. In my view, I think we're going to see a lot weaker growth in H2, not just in the US, but also in Europe, right? So we just got the second estimate, I believe it was, for Q1 GDP. And I think it was revised much lower. I have the figure somewhere I can pull up on my Twitter really quickly while I'm talking. But that got revised lower. And at the same time, you are seeing a lot of consumption growth also weaken. That's 70% of the US economy. And this is something I've been talking about for a long time. The idea of the resilient consumer is not really as resilient as one suspects. And you talk about job creation, and this tweet I put out earlier, job creation also is not as strong as we think. In fact, here, it's a quote from the Bureau of Labor Statistics. Since August 2023, the US has lost over 1.3 million full-time jobs, but gaining 1.4 million part-time jobs. And that the year-over-year measure of full-time jobs has actually technically fallen into recession territory, with full employment down year-over-year for 2 consecutive months, February and March. So there's a lot, and how this ties into oil is a major input for growth. So naturally, if you see weaker growth, you could see weaker oil prices. We saw that in 2018. This is an example I like to cite a lot. The Saudis and OPEC were cutting oil production during the Trump trade war with with Europe and China. And yet oil prices were continuing to fall, yet production was being cut, which in my view signaled that it was really a demand problem more so than anything else. And even after you got that Saudi Aramco attacked by Houthi rebels using a drone on the facilities, oil prices spiked, sure, but they then immediately resumed their previous trend, which was downward, which was derived from that weakened demand. So assuming that growth is going to continue to be strong, yeah, they're cutting production, but in my view, I don't think it's going to continue to be as strong, and that has cascading effects because the Eurozone, China, and the US constitute the bulk of global GDP, with all other perimeter economies essentially being vendors to these 3 major powerhouses. The US is expected to grow at an annualized rate, I believe, now of 1%. So a quarter-on-quarter growth of 0.25, down from 1.6, and then earlier we then thought it was going to be 0.4% on a quarter-on-quarter basis. And you're seeing a weakened consumer, which is essentially, like I said, the steam engine of the economy. So I don't quite see how how OPEC is fitting that into their picture. Because if they assume growth is going to be strong, I mean, sure, that makes sense. It'll elevate prices. But if growth continues to weaken, I mean, that's a different story. That's a really long-winded way of explaining everything. But just given in short, the TLDR, if people skip ahead on this, is I don't think growth in H2 out of the US, China, or Europe is going to be great. And I think that's going to weigh on oil prices.
I honestly, what's kind of interesting is, so if I talk to my fiance, for example, she's in a industry that's in high demand, the tech industry, obviously, and she'll tell me when jobs are kind of flooding in and jobs are not. And the tech industry is and where she's at in the tech industry is also important, but I don't need to go too in details on that. But she'll have these conversations and I'll be like, well, the job numbers keep coming out like this, and I'll see part-time to full-time and so on. And she'll say, honestly, there's nothing out there, and that's kind of like the thing I keep talking about in our letter over and over again, is that there's two different things. There's the economy, there's the market, and there's the economy. The market looks one way. Even the numbers, and we all know the job numbers are very skewed in many different ways. Same with inflation numbers. The government can, we could see the an equal weight commodities index or a market weighted commodity index, however you want to weigh it out. It can be up, 100% in a year, and the Fed is saying, yeah, we have hot inflation. We're at like 4%. Like these things happen, and they happen historically quite a bit. So when you look at the job numbers, like you said, like you really have to figure out where exactly they're going. And I think you're right, is where they're not going into areas where people are, like, if you talk to people who are making good money, there's nowhere to move in their industry. There's tons of part-time work because nobody wants to do it, because nobody can afford to live on it really at this point. Inflation is too high for some, like, we both, I'm sure I have friends, I'm sure you have friends, where they're making good money, but they're also barely surviving. So who can handle part-time work unless it's your second job? So once again, yeah, there's part-time jobs created, and people are probably taking this part-time work because they have to, but at the same time, it's not something sustainable. It's not something that's really going to stoke growth. And that's the thing that oil really thrives in, is that growth-based environment. Oil and copper are the most growth-based commodities that we have. And it's a good way of looking at the market and going, okay, are we in a growth commodity cycle where you see things like oil and copper moving up together? Or are we in like kind of a stagflation style cycle? Not saying stagflation like the 70s, just stagnant growth and inflation possibly moving forward. And you can see that in things like gold. So if we're looking at both of these right now, we're kind of seeing like, hey, there's the possibility of these things working. However, there's some major headwinds ahead. And once again, it's like, I'm not one to call recessions. I'm not saying, hey, recession, sell everything you have. I'm more saying like, it's the market's kind of in a very cautionary place at the moment. We're still long a lot of positions. You got to ride the trends and risk manage however you do. And like I said earlier, there's two different things. There's the market, and then there's the economy. The economy might be looking a little bit rough right now. However, the market could be sustaining, and it could still sustain. And that could say that maybe, we do get into a better place going forward. I don't know. I'm not trying to tell the future here, but what we're trying to talk about right now is where exactly we're at. And we're at a place where that could affect OPEC cutting. So I like that you brought that up and kind of put that all together.
Well, so I'm glad you brought up the distinction between the economy and the market, because that's absolutely right. Just because the economic outlook isn't necessarily the most rosy, it doesn't mean that the market will necessarily follow. And that's something that, I appreciate you stressing that. And that's something that I put also in my macroeconomic forecast, which is just because this is the story of the economy, it doesn't mean markets are going to reflect that. And one thing that I've been, thinking about is, okay, early in this year, what was driving the market higher? Expectations of lower inflation, expectations of strong growth, and the Fed cutting rates. I mean, you couldn't think of a more bullish story, right? Mm-hmm. And yet now all three of those pillars are falling apart. So then it did get me thinking, why does the market continue to climb higher? Is it just complacency? I don't think so. In my view, it seems to be high expectations of earnings. But if you look into corporate earnings, that's predicated on a strong consumer, of which we're beginning to see a weakening. And again, something I've cited before and multiple times is that pandemic era savings are going to are rapidly depleting and are going to become even more empty in H2 of this year. So in my view, I think that could be a catalyst for a bit of a market dip. I wouldn't necessarily say a crash. I'm not that hyperbolic. You know, in full disclosure, I know you're talking about your positions. I see these risks, and it doesn't mean I'm adjusting my portfolio, but I am watching very, very closely. I've liquidated some positions, you know, that are just broad-based equity indices, because I'd rather secure actual gains now than hypothetical ones I could get, because the risk to reward ratio for some of my portfolio positions is just not compelling to keep holding. I'd rather secure what I have now. You know, what is it? Sell in May and go away, as they say. We've got, you know, it's the May 30th, so it's coming up, right? But levity aside, you know, but when it comes to, like, for instance, my thematic investment portfolio, for those, some of those positions, because I'm not looking at it from a cyclical perspective, but something that's far longer and more secular, I don't mind getting additional exposure to those positions, particularly if the secular themes that behind my investment thesis are now being supported more and more. Quantum computing is an example of that. So I'm glad you brought up that distinction, because it is important, because it's very easy and tempting to fall into the macro doomer, Robert Kiyosaki, you know, apocalyptic four horsemen, you know, sort of caricature. But the value, because then people then may rightly ask, well, okay, if you're not adjusting your portfolio, why does this matter? Well, it does, because it then gives you an indication of what to potentially prepare for. Because markets because when markets do realize, oh, wait a minute, what's actually the story here that we're trading? If it's not rate cuts, if it's not lower inflation, if it's not stabilizing geopolitics, if it's not great growth, and it's no longer earnings, what are we even doing? That realization can cause a sharp bout of volatility, particularly with a downside bias. So understanding that and what's driving that can help you position yourself much more optimally. So that's where the macroeconomic analysis comes in. It doesn't substitute for suggesting what you should or should not do with your portfolio. It's another analytical tool to add to your box to say, okay, now that I know that the market potentially has this massive vulnerability, I can position myself accordingly. But it doesn't necessarily mean allocating everything to this, you know, doomer portfolio.
No, I completely agree, and that's the way you really have to look at markets. And once again, it's something that's not to say, you know, there's people who are like, well, that's because fundamentals don't matter, and then the next, you know, video they're putting out, it's, well, technicals don't work anymore, and it's because the macro doesn't matter. And it's like, no, it's not that any of that's true. Like, the fundamentals do matter. It's just when they come into play, exactly like you said. Like, when do those come into play? I don't know. You can't, it's not easy to time. It's not something you can time perfectly. However, you can be ready for that, and ready for the market to possibly change narratives into more of a, hey, is this a real, like, is this rally sustainable anymore because of blank? Like, that's something you need to look at. And maybe it's just something where it goes, okay, there's a possibility of some headwinds here. It is summer. Let's always remember, like, it is the summer months. And when you're in the summer months of trading, we're always kind of in this choppy period. The news flow, the economy, the data releases, they're all a bit choppy and flat, and everybody's just kind of frustrated. There's a lot of people on vacation, a lot of people not trading, volume is low. So
yeah,
we can
that
also
increases the volatility risk. Sorry to interrupt, but yeah, with people on vacation, yeah, it definitely increases. That's why holidays, sometimes you see really high volatility, or like the day after, rather, because it has to compensate for all of that.
Exactly. So I mean, this week could even be a bit of that too. So, you know, I try to always keep those in mind, because it helps me to manage my expectations. Just like you're looking forward, you know, another thing I've been talking about this week, which is the fact that you know, just, it was actually really good timing. it was, hey, you know, the VIX is very low here, and the possibility of, like, you know, the volatility that's going to come into play coming into the election. And as we're sorry, I'm ever since the plane ride, my throat's been a little bit sore. But the election, basically, everything I'm reading, which is kind of funny, they go, there's not going to be any stress or volatility for this election, because the two presidents have already been in office, and it's going to be a real smooth election. And I was like, This is the first time these people have ever written about a U.S. election. Like, are you kidding me? So like, I think that, a couple of easy things to just look out for here is, the possibility of a VIX spike, the possibility of just the implied volatility moving up into the election is enough to make things like calls or puts go up in value over time. Things like that are valuable. Like we're talking about here, looking forward, understanding that's a valuable thing to understand coming into the election, where that's the event risk that the volatility is going to start moving higher for. After the election, volatility is going to fall off of a cliff. Whoever gets elected, some people you're going to, and if you listen to the news going forward, and I hate to sound like I'm trying to tell the future, I'm not. I've just lived through these a bunch of times and traded through them. As we're going into the election, there's going to be tons of people who continue to talk about, if Trump gets in, it'll be blank. If Biden gets in, it'll be like this. And they'll say the market's going to crash if this person gets in, or whatever. My main point is, once we get through this kind of summer season and then we get into the election, whoever gets in office, the volatility will usually come off the market, because the market, more than anything else, hates uncertainty. Because the market hates uncertainty, that's usually when volatility, like right now we're in an uncertain period, getting into the election. Once that comes off, the market's going to know who's the president, and then nobody's going to care. Yes, there'll be people arguing. There'll be plenty of fights you can have with your neighbors or people on social media, I'm sure. But the market being very forward-looking, once the election's over, the volatility is going to fall off of a cliff. So for you, I'm just going to ask, what are you seeing for this year, election-wise? What are you thinking like could be things that people should look out for? Because the last time, and I always love the elections. I study them so much because they're always so interesting to me. Not the who gets, I could care less who gets in office. I like to just study the election cycles. I thought last year was, or not last year, but the last election was super interesting because everybody said if Joe Biden gets in office, make sure you to buy tech, solar. Literally, it was like everything that did poorly. And if Trump gets in office, buy energy, buy banks, basically the Trump style trade, for example,
Right.
old economy style trade. So, but it was funny. Biden gets in, and then energy ended up being the best thing to own that year and into next year and even into 22. So, I'm wondering what you're seeing coming in the election. I wonder if you study. I'm sure you study it, just if as much as me, if not more. So, what are you thinking?
Well, so I'm glad you brought that up, because I think with Trump and Biden there are some differences, but what I'm more interested in, precisely because this election, much like the last presidential one we had, is highly contentious, and you'd think that Biden and Trump are so different. And in many ways they are, but I think in the most important market context ways, I don't actually think so. Because when it comes to tariffs, I mean, Trump called himself Mr. Tariff Man. Yet, and we saw how he imposed tariffs against China, against Europe. We all know that. We've seen that.
Mm-hmm.
And yet, under Mr. Biden, we've seen no repealing of those tariffs that Trump imposed against China. We actually have seen increased tariffs, or not tariffs, sorry, export controls, because there's a difference, I believe, on semiconductors. We saw recently the announcement about Biden putting 100% tariff on Chinese EVs. And most recently, we're going to see more tariffs being imposed against China, but also, I think specifically, what is it? I think it's crystalline photovoltaic cells and modules coming from Cambodia, Thailand, Vietnam, and Malaysia, because because I think those four countries provided 80% of those materials to U.S. Solar, of which China sent it to them. So they're just basically circumventing. So I think the commonality between Trump and Biden is going to be a consistency and a tough on China stance, and the use of like tariffs, for instance, and export controls. Where the difference is I think under Trump, we could see a little bit more volatility. Because, for instance, when Biden imposed some of these tariffs or some of these export controls, he did it in a much more surgical way. And you can measure that by the limited volatility it had across asset classes. versus under Trump, we did see more volatility from these policy measures precisely because they were a lot more broad and because they were a lot more sudden and unexpected. And it was the beginning of this paradigm change that we saw from putting security first over economic integration. Because under the old model, you'd think, well, this is great that China is sending all of these EVs. Don't we want to have a clean energy transition? But no, that's not what we want. There is a security precedent there's a security precedence. One example, in the same way that a lot of the West, particularly the US and Europe, are concerned about 5G and Huawei, they're concerned about these EVs that could potentially be turned into information gathering vehicles, both literally and figuratively. So there's security taking precedence over economic integration. So I think between Trump and Biden, you're going to see something very similar when it comes to tariffs, EVs, solar, and a tough on China stance. Heading into the election cycle, something that I called at the last one is I said, initially, it's going to look like Trump is going to win because this was during COVID, and Democrats are a political demographic more likely to send in mail-in ballots during that time. Mm-hmm. And I said, here's what's going to happen: you're going to see Trump winning, and then you're going to see Biden, likely take over. And surely enough, and I said that, you can look it up on BBC News. And surely enough, that's exactly what happened. And of course, after that, there was all other ideas of election fraud that came up that led to this polarization and all these other topics, which had limited market effects because markets didn't really care, which showed that they didn't take the election fraud content seriously. And they were like, this isn't really something we have to worry about. So going into this election, as far as the uncertainty goes, I'm apprehensive about trusting polls because they're not exactly the most reliable. And there have been so many instances where they've been wrong. For me, it's not really something I'm looking at closely. Sometimes I will tweet it out, and I think it can be quite interesting, particularly in states that are purple or pivotal, like Pennsylvania or Florida. I think Florida in particular, it's predicted, depending on what color Florida turned, it was 9 out of 10 times that was a predictor for what would happen on a national level. I'm not saying it's that high. I'm not saying it's 90%. So don't quote me on that. But it's a really interesting indicator to monitor. So in my view, heading into the election cycle, I would say watch key states, Pennsylvania and Florida, I think in particular. Watch purple states because those are the ones that are on the edge, because those are the ones that are going to be the most interesting. If it's something like out of California, or Texas, we kind of already know our answers there. Mm-hmm. But for those other pivotal states, monitor that much closely. In terms of the personal politics of Biden and Trump, you can make a compelling case for both in terms of what voters are feeling. Mm-hmm. People will blame Biden for inflation, or they'll say, well, we don't want to deal with Trump and his chaos. And it's there's merit to both of those. Sure, fine. To a degree under Biden, it's unclear how much of inflation he is responsible for. But for me, that's really not relevant. I don't really care about those things because it doesn't really have a market impact. So to be honest, I don't know how this election is going to turn out. My only tangible advice is watch the pivotal states, because that's going to determine a lot. If you look at polls, don't treat them as prophecies, and look and see how there is going to be a secular consistency between Trump and Biden vis-a-vis tariffs and tough on China. That's no longer unique to Trump. That's something that Mr. Biden is also taking an approach to as well.
No, that's a good point. And I think in general, it's a very emotional topic for most people, and it's people like us have to take it in a very logical way, because it's the only way to really do it. Everybody has beliefs and opinions. And I talked about this the other week because it was a couple months ago now. I had a guy on, and we were it was actually an almanac trader, stock traders almanac, and we were talking about solar and energy stocks. And it got taken I hated, the idea of solar energy. And it was no, we're talking about it in a way that is how we're weighing the probabilities. Even if it's fundamental analysis or technical analysis, I'm just weighing the probabilities. That's all. That's the best we can do as market participants. And, so when we're talking about the election, it's the same thing. It's not hey, this guy's better than this guy or this. It's how does it affect the world? How does it affect the market? And how will it affect you, the people watching? So, hopping right into it, let's keep moving on. We got so much. We could talk forever, man. This is such a fun conversation every time. So let's talk about inflation. We'll talk about the PCE data, macro inflation. What are we seeing here all over the globe at the moment? Because inflation is at the moment, it's one of the most important things that we're all paying attention to in the markets right now. There's so much going on under the surface. You'll see certain commodities have been booming, and then they'll stop for a little bit and then possibly start up again. It's been an interesting year already. So what are we seeing here?
So yeah, with PCE day tomorrow, that's going to be interesting. I think that's going to be potentially a very big market moving event. It's obviously the Fed's favorite inflation indicator. I think current estimates are about 2.8%. That's what I was just looking up right now. That's what the forecasts are. I think one thing to keep in mind is I could see that if it lands flat, so just as expected, I could see a compelling case for markets because markets seem to want to take any excuse to have a bullish story now, just based on how the S&P and these other indices are performing. So if it's flat and it comes in as expected, I could see markets reacting potentially well to the idea that, well, at least it's not going up. Conversely, you could also make the case of, well, it's flat. And the Fed said, we're not going to adjust rates until we see inflation sustainably coming down, right? Which means consistently, not just, having these blips and then it stabilizes like above 2%. The Fed has made it clear we're not going to compromise if it's above 2%. And right now it's at 2.8. So I think analyzing that will be interesting in this context. As for more to that, the Fed Beige Book was published just yesterday. I'm looking up some of the highlights right now. They did notice a softening of consumer data and price sensitivity to inflation. And if you look at the phrasing that was repeatedly used in the report, light, modest, flat, no change, it essentially is basically saying that the economy is it's lukewarm. It's not red hot. So as for the global macro outlook and inflation, I think the current iteration of politics on a global level is conducive for inflation, because from the 90s to 2008, it was all about economic integration and standardization. Standardization, by definition, lowers the probability of volatility because there are fewer variables to incorporate in any given transaction. It makes a lot of sense. Everything is standardized. Everything has a protocol. Everything's much smoother. If you fragment that and you have different protocols with different partners, it creates much more friction in business and cross-border transactions. In my view, what we're seeing now, because we're seeing nation-first security take precedence above this kind of integration, particularly between the world's largest economies like the US, China, and Europe, that creates a byproduct of the higher inflationary, higher inflationary risks with cascading effects. Not only that, it also increases kind of unilateralism. The Russia's invasion of Ukraine, the impact on wheat and oil, the Houthi attacks in the Red Sea that caused shipping container insurance rates to surge, products to not be delivered or delayed or canceled, fuel prices rising as a result of needing more energy to go through longer but albeit safer commutes. All those things have cascading effects on inflation, and it's not like it just happens over a week or a month or over a year. It's like a multi-year cycle. I'm not saying that inflation is going to stay really, really high for multiple years, but I am saying that there is going to be, in the current environment, an upside bias towards increased prices, because the geopolitical environment and its effect on supply chains for those goods makes it difficult to transact. And if you combine that with the balkanization of data policy and just the internet in general, that also makes these kinds of cross-border transactions that much more difficult, and it gives it a lot more friction. So in my view, I think that's how you could see it echoing into higher commodity prices. The easiest one is oil, right? Because with oil, if you have a region like the Middle East where there is heightened tension, especially now, and spillover effects, of course, that's going to have a disruptive effect on oil. And it doesn't even necessarily have to be the event itself. It could be the fear of an event happening. And we have seen that because, again, markets, they're not dumb. They're forward-looking. They don't respond to an event per se. They respond to the risk of an event. I mean, obviously, they respond to, let me rephrase that. They respond, obviously, to sudden events, but they also to the extent that new information can be incorporated into your portfolio, the market then reflects that. So that's kind of my macro outlook, I would say, and why I could see inflation being stubborn. There's a domestic element to it, but there's also an international portion to it that I think also contributes.
No, I like that. And, when we're looking at markets and inflation, we have to always keep in mind where we could end up. Like you said, like it's something of always looking forward, trying to figure out where we could end up, what the Fed's going to do. That's a thing. And like you said, the market being forward looking, something I wanted to bring up. Something that was explained to me, probably 20 years ago at this point, was, what if the Fed came in and they go, okay, well, we're going to cut rates to zero right now. What if Powell says that on TV? We're cutting rates to zero tomorrow. And what would the market do? Well, everything would change. The market would start trading, inflation would probably skyrocket. Every single commodity would go to the moon. Equities would go to the moon. Everything would be ridiculous. The dollar would get killed and so on. But what actually changed? Nothing. What actually changed? Did anything happen in that minute that he did? No, nothing has changed. So once again, that's just an exercise of understanding how the market works and the way expectations work. If they're like this year and last year, last year the market kind of sniffed out that they were going to stop hiking rates at some point and possibly start cutting at some point. And so the market starts to move higher. Did somebody exactly say that at that time? No, not exactly, but it was known. The market sniffs these things out, and there's a lot of reasons. There's a couple things. One, the markets are forward looking, but two, also someone somewhere knows something. And because of I don't run enough money to move the market up in any major way. If I wanted to, with as much leverage as I could put on, it's never going to happen. But there are countries and there are certain things that can. And so these things possibly start buying, which creates other people start buying. And then the end of that is the retails who start buying at the end. So once again, there's many ways to look at the market, but one of the most important things to think about is how forward-looking the market really and truly is. And that doesn't have to change based on anything more than belief, which is why, we talk about macro and macro themes and understanding these themes and where the market could be going.
And the stories driving them, I would argue. Robert Schiller wrote, Robert Schiller, sorry to interrupt, wrote a great book called Narrative Economics, which, granted, it could be a little dry. I mean, the title itself is kind of an indicator, but the actual book talked about the power of stories, and he overlays the study of virology and infection rate the death rate with the new infection rate of a story and the forgetting rate, and there are remarkable parallels, both of which is it could cause a not mass hysteria per se, but a mass movement of people or capital if the story compels them to do so. And like I said, if all this stuff about the economic data is true, then it doesn't really matter what the facts are. It only matters what the story is, right? And there's even an expression. What is it like? What is it? Buy the facts, sell the story, or something like that. I can't remember. It's something like that.
Buy the rumor, sell the news.
Thank you. That's what it is.
Buy the rumor, sell the news. Yeah, old market wisdom. And that also reminds me of a conversation I had last week. There was a guy named Steven. I can't remember his last name. I feel bad. He actually, I do know his last name, but I can't think of it off the top of my head. He runs a lot of money, very successful guy. A lot more money than most people we know, actually. A very successful guy. But having the conversation with him, and he brought up, he was trying to write an article called Pavlov's New Dog. And it was about the 60-40 portfolio. And, and like I've always had an affinity for talking crap on that thing because I worked in that industry, and, I would come up with strategies and trend following things or certain systems and back tests. And they'd be like, oh, you're stupid, the 60-40 portfolio. And once again, you can't really hate on it, in the right way. Like I have always been a student of market history. And I'm fortunate to have somebody who I learned from who, also hated the idea of a 60-40 portfolio, but he also lived through the period I mean, he would be over 110 now. So I mean, he lived through those periods of the market not trading well in a 60-40 portfolio. So basically, we're talking about the 70s and the 40s and the 50s and the 60s. Like, as 60-40 portfolio wasn't that great back then. And so talking about market participants, he mentioned that, it's kind of like Pavlov's new dog, where it's like, how many years do you have to get shocked and believe that this portfolio is going to work out so well? And it doesn't until you possibly shift your ideas. Now, anybody who studies market history knows that bonds are very cyclical. And I'm not saying I know the future, but I'm just saying the past, bonds have been in 40-year cycles, 40-year uptrends, 40-year downtrends. It just came out of a 40-year uptrend, which was 82 to all the way to 2020. Not exactly 40 years, but it's around 40 years. And now it's kind of topped out in 2020, and now it's going the other direction. Bond prices have been going down. So once again, it's really interesting to just think about the psychology around the market. As we're talking about the markets being forward-looking, I'm also thinking about at least market participants and how they get very stuck in their ways. And so, another thing I wanted to ask about, we're talking about jobs, we're talking about inflation. What are you thinking about the bond market going forward from here?
In short, I don't know. I actually would be very curious to hear your opinion on that. One thing I will say, though, that I'm interested in, and I don't know much about it, so I'm not going to talk about it, is the trajectory for dollar-denominated sovereign bonds, particularly in EMs. Because it'll be very interesting to see what the funding environment would be and the appetite for those. South Africa is a great example of that. And how, if you combine economic turbulence with not stagflation, but let's say suboptimal growth and tight credit conditions and risk aversion to comparatively riskier assets, of which EMs are just by their nature, it will be curious to see if it produces any sort of macro scale, not instability, but let's say reverberations that could make people a little bit nervous. Because again, if you have a strong dollar and you're an EM and your debt is denominated in the dollar, it's obviously going to take a lot more of your local currency to service that debt. And the yield for it will be comparatively higher because of potentially the high risks of purchasing that debt. So I'd actually be very curious to hear your opinion on it, because that's not an asset class I've been looking at too carefully, at least not to the full extent that you have been.
Yeah, I mean, I look at the bond market a lot just because as a futures trader I have to, and we've been short the whole curve for a while again. Like it's interesting, and something I also brought up last week, which was from 2020 to today, there's only been one false signal in the bond market. So basically, we've been short the bond market with only one whipsaw since 2020, since that initial breakdown that happened in fall 2020. So that's a really interesting thing to think about when we're looking at any market. I have seen major trends happen many times in many different asset classes. Cocoa obviously is the latest one. Bitcoin had a crazy trend in 2016 through 17 that was pretty long. I can't even think of anything that's been longer than this bond trend. Just a horrible downtrend, and anybody who's been invested in it has gotten killed. And something about the industry, when you're in that industry and it, because you've lived through it as well. When you're in that industry, they tell you grab somebody and you go, okay, how old are you? Oh, I'm 40. Okay, cool. You should have 40% bonds in your portfolio. Great. Okay, you're 50. You should have 50% bonds. You're getting a little older. We need to take the risk out of there. Let's say you're 20. Okay, 20% bonds, because you can be more riskier. Like, they never take the macro into consideration or the environment or anything. But however, the thing like I brought up earlier, it's worked since 1982. So people don't think about it, especially even the people who are selling those products. They could be 60 years old. They could have invested for 40 years at this point. They could have seen that their growth has been great and their portfolios looked great all these years until recently, however. And they're going to believe the whole time that it's going to go back into an uptrend. I think that's the thing that's going to be the most interesting piece of it, is that they continue to believe that at some point this is going to shift perfectly back into a new uptrend and continue. And I'm not saying it's impossible. I'm saying that if you put all of your eggs into a basket and you go, this has to work because this is how it's worked in the past, you're going to get killed at some point. It's the same thing that, if you're a trend follower, if you're completely fundamental and you only look at one indicator, whatever it is, like, you can't get too stuck in your ways no matter what it is. I'm very stuck in my ways of being systematic, but you better believe if I'm sitting there for 4 straight years and it's my system and strategies in a downtrend, I'm going to maybe think I'm doing something wrong, So I think it's going to take time for people to really unwind that idea. So I think we'll still see rallies in the bond market. I think we'll still see big rallies, just like we saw from 1940 all the way to 1980. I saw these big moves up in the bond market, even though it was technically in a downtrend. So I think we'll still see that. However, I think the primary trend, and however you measure that, 52-week highs, 52-week lows, or 200-week moving averages, however you measure that, I think the primary trend will stay to the downside. Do we get over a moving average? Maybe, sure, but I'm thinking it's going to stay downward sloping for a long time, and there'll just be points basically to trade it, but owning it just like a flat portfolio, I think, is a bad idea. I think even though I wouldn't say like stocks are the best thing ever, always own stocks, I think if you had to, gun to my head, and what's funny is I had this conversation at the perfect time with an older woman and an older male, and they were asking me my opinions on the bond market. The guy had owned bonds. I mean, he had to be 90 years old at this point. He actually passed away pretty recently. And it was him and his girlfriend at the time. And they were asking about, what to do with his bonds and what should she do with her bonds in her portfolio. And I was like, in this type of environment that we're in, I hate to say it because I'm not a person who says go all into stocks because I'm a trader. But at the same time, I would rather be in stocks in an inflationary cycle than be in bonds in an inflationary cycle. I think the stocks will have more upside than the bonds. And that was spot on at the time. Do I know where that's going to be today? Not sure. Like, once again, people would say, hey, bonds probably now would probably start to catch up a little bit or catch a bid. I don't think it's impossible for them to catch a bid. I'm just saying new all-time highs in bonds will be pretty hard to achieve in this type of environment.
Right. So a couple of questions there, actually. So I think one probably too is a function of what's the dividend yield for equities or equity indices and bonds. That's one. There's also treasurer inflated protected securities or TIPS. I'd be curious to get your opinion on that. But what I'm curious about most importantly is, what do you think is going to be the thing that's dragging bond prices lower? Do you think is it primarily a function of the Fed? Is it primarily a function of the international sphere? I'm curious, like, what you think that catalyst is that you've identified, and is it even the same one for the past 40-year cycles?
So it's almost always the same one, and it's not that. Once again, I'm not saying like we're going to stay in this hyper downtrend forever. I'm more saying like upside will be limited. It'll be tradable. It will not be something I would say, hey, somebody invest in these bonds for the next 20 years. So how do bonds work is first the question. So bonds are usually, during certain times, bonds work very well with growth. Like sometimes you have high growth and bonds can start to go flat to down. So they're inverse to growth. They're also inverse to inflation. Everybody knows that. So, if inflation starts to move up heavily, bonds start to take a hit as well. Now, this is also just how investors view it, right? Because if you really want to buy bonds and buy oil at the same time, you could. However, this is how investors envision it, because if the inflation rates are so high and the bond rates aren't as high as the inflation rates, people would rather invest in these commodities or equities or something else, just like you mentioned with equity rates, the dividend yield compared to the bond yield. So, once again, it's and you mentioned I bonds earlier. I actually really liked the I bonds a few years ago. We had a really good opportunity to buy a bunch of them, and we did. This was 2021 ish. there was a 10% yield on those. So we ended up buying those a while ago, and I told my clients about it too. It was a pretty good buy. You could only buy a certain amount, so it had to stay kind of small unless you had multiple LLCs. If you had multiple LLCs, you could buy a little bit more. So some people did it like that, but the I bonds were pretty cool. The tips, if I was to buy the tips, I wouldn't buy the tip ETF. I wouldn't do that. I don't really think there's much of a difference there, much alpha there. I would rather, if I'm really looking at that, I'd rather own the energy sector or an energy stock or something like that instead of tips. But to diversify, I like the idea of just buying the I bonds straight from the government. But going forward into the bonds, just kind of looking at it and going, okay, well, I don't think there's a possibility in this type of environment. I think it's not that I think inflation is going to continue to get out of control and it's just going to go crazy forever and we're going to go into hyperinflation. We're all going to die. I don't believe that. I believe, however, that inflation will stay elevated. I think it will stay at these elevated levels. I think because of that and the amount of debt we have, we probably end up into a zone where bonds don't continue. Where bonds just kind of continue in this downtrend going forward, and we continue to just kind of be in this point where people who are investing in it continue to lose money in bonds. I just think it's a bad investment long term. I think you could trade it in the short term. There'll be points where the Fed starts to cut. There'll be reasons to trade in the short term, but the long term, I just wouldn't do it. I think there's better places to be and better ways of diversifying people's portfolios.
Right. No, that makes a lot of sense. And it sounds like what you said too about the idea that inflation is going to remain a little bit, not to quote the Fed too much, but higher for longer, seems to also fall in line with the sort of forecast I was making about how the international environment is conducive for pressuring domestic inflation as well. So it seems like there is a conjunction of those two kinds of theses.
No, perfect. So anything else you want to end on? We talked about job data. We talked about investors
PCE
seem
and
focused on the outlook of corporate profits would be a cool one. So what do you think in corporate profit wise? Because I missed that. Dimitri sent me some great notes. So what are you thinking there?
Well, I mean, it's unclear, right? Because again, corporate profits are a function of a resilient consumer. And if you're beginning to see a weak consumer, obviously there's a little bit of worry there. As far as how that translates to actual market price action, I mean, Nvidia seems to be Atlas holding up the world of equities, right? And I know people post those memes saying, "Here's what our post-apocalyptic world is going to look like if Nvidia misses earnings," and it's a joke, but there's a kernel of truth in there, I think, to a degree. And obviously, demand for AI is surging. We're seeing that with increased demand for electricity use for these AI data centers. Kevin, who you have on frequently, great guy and super smart analyst, has addressed this more so than I have, and it's an area that's piqued my interest. As far as earnings go, I think we're going to see some softening in H2, and I think if inflation hasn't changed, and oh yeah, that's the other thing I was going to mention is that if inflation hasn't changed and the rate outlook hasn't changed, I think that's also going to turbocharge volatility. And here's why. Right now, we have a 6-month horizon roughly of where we could potentially get interest rate cuts at several meetings that are coming up. And there's only few. So the fact, as the timeline gets shorter and shorter and shorter for when we may get a rate cut, that I think is going to induce more market panic. Because now it's, we've got 6 months. A lot can happen in 6 months. A lot can change. But then you get down to 3 months and then 2 months. And you're thinking, okay, there's only so many meetings now we have left that we could potentially get an interest rate decision and reality begins to sink in. I think as far as earnings go, if you continue to see weaker growth in the consumer, I don't see how earnings can continue to climb. Because you could say, well, yeah, corporations could then start cutting back on personnel and right sizing, not downsizing, but right sizing, as they say. But that's not going to be enough. Like, corporations don't make up the bulk of consumption. It's individual consumers that are employed at these corporations that do. So if you see layoffs, you see part-time jobs with people who don't have as much discretionary income as those with full-time jobs, where are those earnings going to come from? So I guess that's kind of my question. And part of me is asking rhetorically, but the other part of me is asking literally, where is that earning strength then going to come from if it's not going to come from a resilient consumer?
No, I like that, and that's something. Let's end right there. That's really good because it's something that people can think about. People can also write Dimitri and I. Feel free to write us or comment on our page. Please give Dimitri a follow as well. Follow Substack actually too. A bunch of great research on there, and we'll end on that. Please reach out to us. All right, guys. We'll talk to you soon. Thanks, Dimitri. Thanks so much for coming on.
Great to be on. Looking forward to next time.
All right, man.